Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine the master budget. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. What is a master budget? A master budget shows the overall summary of the functional budgets, including the budgeted financial statements. So, a budget that shows the overall summary of the various functional budgets, including the budgeted financial statement, is said to be the master budget. A master budget is a budget that shows the summary of the various functional budgets, including the budgeted financial statements. So that means a functional budget encompasses all the functional budgets I've examined in my earlier video, plus the budgeted statement of profit or loss and the budgeted statement of financial position. A master budget is a budget that shows the overall plan of the business for the next period. A budget that shows the overall plan of the business for the next period is said to be the master budget. So, I've told you the various functional budgets forms part of the master budget, which include the preparation of sales budget, and these have been examined in my video on functional budgets. 2, we have production budget, and these have equally been examined. Then material usage budget, material purchase budget, materials purchases budget, then we have direct labor or direct wages budget, then overheads cost budget, which includes the variable overheads and the fixed overheads budget. Then cash budget, and all these budgets have been examined in my earlier video on functional budgets. Then, in addition to all these functional budgets, budgeted statement of profit or loss will be included. Budgeted statement of profit or loss and budgeted statement of financial position. So, this is master budget. So, I will further expatiate the budgeted financial statement, that is the budgeted statement of profit or loss and the budgeted statement of financial position. Remember, the statement of profit or loss is prepared, to ascertain the profits or losses incurred in the period. So it is prepared to ascertain the profits or losses incurred in the period. That is statement of profit or loss. I want to know that statement of profit or loss is prepared in line with accrual basis. So we use accrual basis to prepare profit or loss. It means items that does not involve flows or cash will be included. Items such as depreciation will form part of the budgeted profit or loss. You will need to include depreciation, the bad debts, allowances for receivables, all those items or provisions, we will need to include them item that does not involve the flows of cash will form part of the budgeted profit or loss. Take note of that. We use accrual basis. On the basis of accrual basis, you recognize transaction when they occur. That is, revenue and expenditures are recognized when they occur. Revenues and expenditures are recognized when they occurred, and not when cash is or are received or paid. So that is accrual basis. So under accrual basis, you recognize revenue when they are earned, and you equally recognize expenditure when they are incurred, not when cash are received or paid. That is accrual basis. So accrual basis is used for the budgeted statement of profit or loss. Format of budgeted statement of profit or loss. Budgeted statement of profit or loss. The starting point is the budgeted revenue. Budgeted revenue. Budgeted revenue, which will be quantity sold times selling price. So this will give you the budgeted revenue. So from this, you less variable cost. I want to use marginal costing approach. Less variable cost, and the variable costs include opening inventories or opening stocks. Inventories. There are two types of inventories that are common in exam questions. You have inventories of raw materials. The opening inventories may be given, valued at standard material price. To the standard price of material given in the question that will be used to value our opening inventories of raw materials. Then opening inventories of finished goods. Valued at standard cost. It could be standard marginal cost or standard absorption costing. I will give you this later as a working, how to calculate this. So this will give you the value of opening inventories. You add purchases of materials. These purchases will be obtained from material purchase budget. It will be obtained from material purchase budget, if any. The figure you obtain from your material purchase budget, you add it. That is purchases. Then if you have direct labor or direct wages, you add direct labor or direct wages. Then variable overheads. And if you are using standard absorption costing, your fixed overheads will be absorbed into it. You may have fixed overheads if you are using absorption costing. So now less closing inventories. Closing inventories of raw materials, and that of finished goods. You value this same way the opening inventories were valued. The same way you value your opening inventory, the same price or cost you use in valuing your opening inventory will be used to value the closing inventory. So when you less the closing inventory, you get the direct cost or variable cost or total variable cost. If you deduct the direct or your variable cost, you get the budgeted contribution. Budgeted contribution. After your contribution, you deduct your fixed cost. You less fixed cost, fixed less fixed production. Let me say fixed cost, including depreciation, if any. Then bad debts, allowances for receivables, you deduct that. So, and other expenses that I may not write. Remember, after deducting all this, you arrive at the net profit. This is the format for preparing the budgeted profit or loss. But I want to note that the capital items should be excluded. We don't use capital expenditure in the budgeted profit or loss. So you should remember to exclude capital expenditures such as expenditure incurred in acquisition of non-current assets, purchase of non-current asset, or any forms of capital expenditure. You exclude them because it's only revenue items that should be included. I talked about this valued at standard material price. Okay, valued at standard cost. So I've told you these standard costs may be of two types. Your standard cost, to use in valuing our inventories. I've told you it could comprise the standard marginal cost or standard absorption costing. But your standard marginal cost may include direct materials, direct wages, the standard cost. This information will be obtained from the standard cost or standard cost card. Then variable overheads. By the time you sum up all these, you get the standard marginal cost. Standard marginal cost. It is this standard marginal cost that will be used to value your inventory if you are using marginal costing school of thought. That is your inventory of finished goods. I'm particular about valuation of the inventory of finished goods. The material price will be used to value the raw material, but to value your inventory of finished goods, you use standard marginal cost where the examiner recommends that. But if you want to use standard absorption costing, so the only difference is you will include the fixed production overheads. Fixed production overheads absorption rate. This may be given, and where it is not given, then that means you will need to calculate that. If you add the fixed overhead absorption rate, you will get the standard absorption costing. Standard absorption costing. I've told you the whole essence of this is the valuation of inventory of finished goods, valuation of inventories of finished goods. That is why you need this information. This The whole essence of this, if you want to value it at standard absorption costing, so that is the formula. But where the fixed overhead absorption rate is not given, then you will need to calculate that. Fixed production overhead absorption rate. Fixed overhead absorption rate. The formula is budgeted fixed overheads. Budgeted fixed production overheads over budgeted level of activity. So you may have administrative expenses, you may have selling expenses. So you should remember to chart them and deduct those ones that are fixed here. So those ones that are variable, you will deduct them too. So this is the format for preparing the budgeted profit or loss. I want to take a question as what example from Workout Performance Management by Ade Omolehinwa. Keep watching. Example, ABC PLC is a manufacturing company which makes product ZICA. The budgeted monthly production and sales are 200,000 units. The standard cost has been estimated on the basis of direct cost of 7 naira for materials. That is 2 kg at 3 naira 50 kobo, 3 naira 50 kobo per kg, and 6 naira for wages, half an hour at 12 naira per hour. In addition, variable overheads have been determined as 2 naira per unit and monthly fixed overheads at 200,000 naira. Monthly sales for the first 5 months of 2023 have been estimated as, we have months and units. January, 210,000 units. February, 180,000 units. March, 210,000 units. April, 220,000 units. May, 200,000 units. Actual sales at the end of 2022 were 190,000 in November and 220,000 units in December. Cash received from sales is based on previous experience and is expected to be received 60% in the month of sales, 25% in the following month, and 10% 2 months after the sales. It is expected that 5% will be irrecoverable and will be written off in the month of sales as bad debts. The selling price is 18 naira per unit. Payable for raw materials are paid at the end of the month of purchase. Direct wages are paid in the month in which they are incurred. Variable overheads are paid 60% in the month in which they are incurred and 40% in the following month. Fixed overheads include 25,000 naira of depreciation and are paid 1 month after the costs are incurred. At the 1st of January 2023, creditors for variable and fixed overheads are estimated as 92,000 naira and 150,000 naira respectively. The company intends to have finished stocks at the end of each month equivalent to 15% of the following month's budgeted sales. For raw materials inventories, the policy is to have 25% of the following month production requirements. Inventories at 1st of January 2023 are estimated as 22,000 units of finished goods and 104,000 kg of raw materials. The cash balance at 1st of January 2023 is estimated as 31,000 naira. Required. Produce for the months of January, February, and March 2023. A. Production budgets. Budget in units. B. A materials purchases budget. C. The cash budget. And D. A budgeted profit and loss account for the 3-month period. Now, let's have the solution to the question. The budgeted period at the month of January, February, and March of the year 2023. So the first budget, the requirement A, you want to prepare production budget in units. Solution. The name of the entity is ABC PLC. You have ABC PLC. From the requirement A, you have to prepare the production budget for the month of January, February, and March of the year 2023. So we have March, we have February, and January. These are the budgeted period. So every workings must be in units. I've told you that to prepare the production budget, the starting point is the budgeted sales in unit. If you look at the question, you were told monthly sales for the first 5 months of 2023 have been estimated as, you have January, February, and March. In January, the sales is 210,000, February 180,000, March 210,000. So we have budgeted sales. For the month of January, the budgeted sales is 210,000 units. In February, the budgeted sales is 180,000 units. And in March, we have 210,000 units. I've told you, after the budgeted sales, if you have watched my earlier video on functional budget, so you will get to understand how to prepare production budget the more. So I will advise you go over my earlier video on functional budget for better understanding. So we add closing inventory of finished goods. Closing inventory, closing inventories of finished goods. Let's go through the additional information for the information that will lead us into this. You were told the company intends to have finished stocks at the end of each month equivalent to 50% of the following month's budgeted sales. The closing inventory of finished goods will be 15% of the following month budgeted sales. So it means for January, for the month of January, that will be 15% of February budgeted sales, and that amounted to 180,000 units. 15% of 180,000, that gives us 27,000. So we add the 27,000 to 210,000, then we have, let me leave that for now. Then for the month of February, we have 15% of sales in March, which is 210,000. 15% of 210,000. That gives us 31,500. And for the month of March, we have 15% of April sales. And you are given the sales for the month of April to be 220,000 units. So if you calculate 15% of April sales, that will give us the closing inventory in the month of April. So we have 15% of 220,000 units. That gives us 33,000 units. That is the closing inventory. So if you add the closing inventory, 33 plus 210, that will be 243,000. Then 180,000 plus 31,500, that is total 211,500. Then 27,000 plus 210,000, that is total 237,000. Then after the closing inventory, you less opening inventory of finished goods. Opening inventories of finished goods. So to calculate the opening inventory, whatever you have as the closing inventory for this month will be the opening inventory of the following month. The closing inventory in January, that is the opening inventory in February, which is 27,000. That becomes the opening inventory. We deduct the 27,000. The closing inventory in February, that will be the opening inventory in March, which is 31,500. Now, whatever you have as the closing inventory in December 2022, that will be the opening inventory in January 2023. Now, let's go back to the notes. We're told inventory at 1st of January 2023 are estimated as 22,000 of finished goods. So this is the opening inventories of finished goods. Please take note of that. It is given in the question. This opening inventory of 22,000 is given in the additional information. So if you subtract the opening inventories, then you will arrive at the budgeted production for the period. So 237,000 minus 22,000, that gives us 215,000. This 215,000 is the budgeted production for the period. That is the production budget required. So for the month of February, we have 211,500 minus 27,000. So we have 184,500. For the month of March, we have 243,000 minus 31,500. So we have 211,500. This is the budgeted production for the period. That is the requirement A. Now back to the requirement B. In requirement B, you have to prepare the materials, purchases, budget. You want to prepare the material purchase budget for the month of March, January, February, March. So we have March, we have February, and we also have January. If you have watched my earlier video, I've told you to prepare material purchase budget. The starting point is the material usage budget. So material usage budget. And I've told you to solve the material usage budget, you have the level of usage times the budgeted production. That is the result obtained from the production budget, you will multiply it by the level of material usage. Now, back to the question. A standard cost has been estimated on the basis of direct cost of 7 naira for materials. 2 kg at 3 naira 50 kobo per kg. That is how they arrive at 7 naira. 2 times 3.5. But the usage must be in quantity, and the quantity of material is in kilograms. So the material usage is 2 kg. So that means our workings here will be in kg. kg. So for the month of January, to achieve a unit, 2 kg of materials were used. 2 kg times, what is the budgeted production in the month of January? 215,000. 215,000 units. So you have 2 times 215,000. That gives us 430,000 kg. Then after January, the month that follow is the month of February. And the material usage in the month of February, we have February. The level of usage is 2 kg. 2 times the budgeted production in February is 184,500. 184,500. 2 times 184,500. Then you have 369,000 kg. For the month of March, remember the material usage still remains 2 kg. Times, what is the production budget in the month of March? We have 211,500. 211,500 units. 211,500 times 2. That gives us 423,000 kg. That is the material usage budget. But you want to calculate the material purchase budget. So I will advise you go over my earlier video on functional budget for better understanding. So I've told you at this juncture, you add closing inventory of raw materials. You add closing inventories of raw materials. Remember, you were told the company intends to have finished stocks at the end of the month, equivalent to 15% of the following month's budgeted sales. That means they are talking about closing stocks here. For raw materials inventories, the policy is to have 25% of the following month production requirements. What is required for production in the following month? 25% of it will be held as inventory. So in the month of January, 25% of February requirement. The production in the month of February will require 369,000. So you have 25% of 369,000. That will be the closing inventory in the month of January. So 25% of 369,000. That gives us 92,250 kg. In the month of February, what is required for production in the month of March? 25% of that, which is 423,000, will be required in the month of February. So we have 25% of 423,000 kg. So 423,000 kg, 25% of that. So it gives us 105,750. So To calculate the closing inventory in the month of April, you must have known what is required for production in the month of March. So since we did not include April in our budgeted period, so we will need to calculate that. Remember, the starting point is the production budget. You must have known your production budget before you can calculate your material usage. You need the production budget, the budgeted production, before your material usage. So it is the usage in the month of April that will be used to calculate the closing inventory in the month of March. That is, the month of March, the inventory, closing inventory, will be 25% of what is required for production in the month of April. And we did not have that since we didn't solve for the month of April. So you need the production budget for the month of April. Then we now multiply the production budget in the month of April by 2 in order to get what will be required for production in the month of April. So we'll be able to use that to calculate the closing inventory in the month of March. But to do that, to solve for production budget, what is the budgeted sales in the month of April? We had 220,000 units. Let me have working number 1. Production budget for the month of April. For the month of April. So production budget, you start with the budgeted sales. In the month of April, the budgeted sales is 220,000 units. 220,000 units. Then you add the closing inventory of finished goods. Closing inventory of finished goods. Remember, you were told stocks at the end of each month. The company intends to have finished stocks at the end of each month equivalent to 15% of the following month's budgeted sales. That means we have 15% of sales for the month of May. Since it's following month's budgeted sales, 15% of May sales. And the sales in the month of May is given to be 200,000 units. So that means you have 15% of 200,000 units. That will be 30,000. If you add the 30,000 to 220,000, you have 250,000. Then from this, you deduct opening inventory of finished goods. Whatever you have as the closing inventory of finished goods in the month of March will be the opening inventory in the month of May. Of April. The closing inventory in the month of March, the closing inventory is 33,000 units. That closing inventory in the month of March automatically becomes the opening inventory in the month of April, so which is 33,000 units. If you subtract 33,000 from 250,000, then you'll be left with 217,000 units. That is the budgeted production in the month of April. Now that you have the budgeted production to be 217,000 units, material usage is given to be 2 kg in the question. Therefore, usage requirement, because you were told the company intends to have finished stocks at the end of each month equivalent to 15% of the following month budgeted sales. You were told for raw materials inventories, the policy is to have 25% of the following month's production requirement. What? Therefore, the material usage in the month of April will be 2 times 17,000. 2 times 17,000. So if that gives us material usage budget. That is this times 2. 217,000 times 2. That gives us 434,000 kg. That is the production requirement in the month of April. The production requirement in the month of April is 434,000 kg. That is work number 1. So 25% of 434,000. That gives us 108,500. That is the closing inventory in the month of, that is the closing inventory of raw materials in the month of March. Plus 423,000 kg. That gives us 531,500. Then for the month of February, 369,000 plus 105,750. That gives us 474,750. Then for the month of January, we have 430,000 plus 92,250. That gives us 522,250. Then you now deduct opening inventories of raw materials. You less opening inventories of raw materials. Whatever you have as the closing inventory in the month of January becomes the opening inventory in the month of February, which is 92,250. The closing inventory in the month of February becomes the opening inventory in the month of March, which is 105,750. Therefore, what is the closing inventory in the month of January? Back to the note. Inventories at 1st of January 2023 are estimated as 22,000 units of finished goods. This is for finished goods. And 104,000 kg of raw materials. So the opening inventories, no inventory as 1st of January 2023, that is the opening inventories. That is 104,000 kg for raw materials. So we have 104,000 kg. If you now deduct the opening inventory, if you subtract the opening inventory, then you have material purchase budget in quantity, in kg. 418,250. That is material purchase budget. Material purchase budget in kg. So that of the month of February, we have 474,750 minus 92,250. So we have 382,500. That is the material usage budget in the month of February in kg. Then in March, we have 531, 500 minus 105, 750. So we have 425, 750. That is the material usage, a material purchase budget in kg. You were told that the budgeted monthly production and sales are 200,000 units. A standard cost has been estimated on the basis of the direct cost of 7 naira for materials. That is 3 naira 50 kobo per kg. 3 naira 50 kobo per kg. 2 kg at 3 naira 50 kobo per kg. So the purchase price of material is 3 naira 50 kobo per kg. This standard cost of 7 naira is the weight of 2 kg by 3.5. So since it is 3.5 naira per kg, that is what we will use to value a material purchase budget. So we have purchase price. Purchase price per kg. That is 3 naira 50 kobo. 3 naira 50 kobo. 3 naira 50 kobo. Then material purchase budget in naira. Material purchases budget. That is in naira value. That is in the value now. So for the month of January, we have 418,250 times 3.5. That gives us 1,463,875. That is for the month of January. In the month of February, we have 382,500 times 3.5. That gives us 1,338,750. Then for the month of March, we have 425,750 times 3.5. That gives us 1,490,125. That is the material purchase budget. That is requirement B. In the requirement C, you have to solve for the cash budget. So we want to solve the cash budget now. In the third requirement, we are to solve cash budget. So we have ABC PLC as the name of the name of the entity. So we have cash budget for the month of January, February, and March 2023. So this is our cash budget. So we have January, February, March, and total. The starting point is the receipts. We want to have the items of receipts. The starting point of our cash budget are the items of receipts. So the receipts item we have in the questions could be the receipts from customers in respect of the sales that were made in the period. So on the basis of that, we will need the sales budget. Let me have that as working number 2. Working 2, sales budget. We have March, February, we have January. We can include the previous month. So, because we are going to analyze the sales on the basis of that time lag. You have the sales for the period, January to 10,000 units, February 180,000, March to 10,000 units. You have sales in units. For the month of January, 210, February 180, March 210. 210,000, 180,000, 210,000. And the selling price are provided in the question. The selling price is the amount at which each of the units of the items sold were made. How much were those items realized? So if you look at the selling price, you have the selling price is 18 naira per unit. Selling price, ₦18. Sales revenue, that is this budgeted sales unit times the selling price. 210,000 times 18. That gives us 3,780,000. In February, 180,000 times 18. That gives us 3,240,000. In March, 3,780,000. Now, let's look at how the credit sales, how they are to be received, or how the receipts are to be made in respect of the credit sales. Actual sales at the end of 2022 were 190,000 in November and 220,000 in December. Now, let me have, no, this is 2023. So we have 2022, November. You were told the sales is 190,000 units. If the selling price is 18 naira as given, you could have 190,000 times 18. That is 3,420,000. Then, sorry, this is, okay, this is for November. Let me have November here. November and December. November 190,000 units at the price of 18. That gives us 3,420,000. In December 220,000 units. 220,000 times 18. 220,000 times 18. That gives us 3,960,000. Now, how are these credit sales? How are they to be received? Back to the question. Cash received from sales is based on previous experience and is expected to be received 60% in the month of sales. 60% will be received in the month of sales. 25% in the following month. 25% will be received in the following month. This is month. Manage it. And 10% 2 months after. 10% 2 months after. So that means what have been received so far? 60 plus 25, that is 85, plus 10, that is 95%, remaining 5%. It is expected that 5% will be irrecoverable and will be written off in the month of sales as bad debts. You have a bad debts of 5%. So bad debts should not be recorded because it is not a cash flows. So we won't include bad debts because it is not a cash flows. Now, what is 60% of 3,420,000? That gives us 2,052,000. 2,052,000. 60% of 3,960,000. That gives us 2,376,000. We were told 60% will be received in the month of sales. 3,780,000. 60%. That is 2,268,000. We are recording it against that very month because we were told 60% of that monthly sales will be received that very month of sales. So that is, it means of the sales that were made, 3,780,000, of these 3,780,000, 60% of it will be received that very month. So for the month of February, 3,240,000, 60% of that gives us 1,944,000. And the sales that were made in the month of March, which is 3,780,000, 60% of that, that is 2,268,000. Then 25% will be received in the following month. It means 25% of the sales that were made in the month of November will not be received in the November, but it will be received the month that follows November, which is December. So we put dash in the month of November, since that nothing of that 25% will be received in the month of November. So the sales that were made in the month of November is 3,420,000. 25% of 3,420,000. That gives us 855,000. That will be received in the month of December. So we put it against December, which is 855,000. Then of December sales is 3,960,000. 25% of that will be received the following month. The following month will be January of 2023, which is 990,000. And of January 2023 sales, which amounted to 3,780,000, 25%, which will be received in the following month, amounted to 945,000. That will be received in the month of February, which is 945,000. And of the February 2023 sales, 25% will be received in the month of March. And the February 2023 sales is 3,240,000. 25% of that will be received in the month of March 2023, and that amounted to 810,000. Then of the sales that were made in November 2022, 10% will be received in 2 months after. That means 10% will not be received in November. It will not be received in December 2022 until January 2023. So what is 10% of 3,420,000? That will be 342,000. That will be received in January 2023. Then of December 2022 sales, December, nothing of that, of the 10% will be received in December. It won't be received in January until February 2023. And 10% of 3,960,000 will amount to 396,000. 396,000. Then of January 2023 sales, 10% of that will not be received in January. It will not be received in February until March 2023. So 3,780,000. 10% of that will be 378,000. 378,000. These are the receipts that were made, or these are the amount received from customers during the period. Now let's sum them up. 2,268,000 plus 810,000 plus 378,000. That is totaled. That is totaled 3,456,000. Then in February, we have 1,944,000 plus 945,000 plus 396,000. That is totaled 3,285,000. 3,285,000. Then of January 2023, 2,268,000 plus 990,000 plus 342,000, and that is totaled 3.6 million naira. Now let's have receipts from customers. Receipts from customers. Working 2. In the month of January, we have 3.6 million. In February, we have 3,285,000. 3,285,000. In March, we have 3,456,000. And the total is 10,341,000. Now, let's go through the question to ascertain if there are other items of receipts that need to be included in our cash budget. Since there are no items or no other items of receipts, so we consider the payments. Now, our payments include payment for material purchased. That is from our material purchase budget. In the month of January, we have 1,463,075. In February, we have 1,338,750. In March, we have 1,490,125. Now, let's see when the payment will be made for raw materials. Then you were told payable for raw materials. Payable for raw materials are paid at the end of the month of purchase. It means the payment for materials are made at the end of purchase. That means all the payments for materials purchased, obtained from material purchase budget, will be used the very month the materials were bought. Since they were paid at the end of the month of purchase, it means they will be used in the very month of purchase. So from our material purchase budget, in the month of January, we have 1,463,705. In February, 1,338,750. In March, 1,490,125. So we are going to include them in the cash budget like that, since the payments were made at the end of the month of purchase. So we have material purchase. That is purchase. This material purchase were obtained from the purchase budget. In January, we have 1,463,875. In February, we have 1,338,750. In March, we have 1,490,125. So what is the total of the material bought within the budgeted period? 1,463,875 plus 1,338,750 plus 1,490,125. So we have 4,292,750. Now, aside the material purchased, what are other items of payment given in the question? We were told direct wages are paid in the month in which they are incurred. Now, let's have direct wages. The budgeted monthly production and sales are 200,000 units. A standard cost has been estimated on the basis of direct cost of 7 naira for materials. These have been used in material purchase budget. And 6 naira for wages. Half an hour at 12 naira per hour. Half of 12 naira gives you 6. 1/2 of 12 naira, that is 6. So that means this 6 naira represents the wage rate per unit, while this one represents wage rate per hour. So if you multiply this 6 naira by the budgeted production, it will give you the wages rate per unit or labor rate per unit. So if you multiply the 6 naira by the budgeted production, you will get the total direct wages paid for the period. Or if you multiply half hour by the budgeted production, it will give you the budgeted hour. The budgeted hour you got, you now multiply by 12 naira. That will give you the direct wages incurred for the period. You either use 6 naira to multiply the budgeted production, or you multiply the budgeted production by 1/2, then the result obtained you multiply by 12 naira. So it will give you the same result. Working number 3. Direct wages. We have 3 months for the month of March, for February, for January. The budgeted production. The budgeted production obtained from the production budget. This is budgeted production, 215,000 units in the month of January, 184,500 in February, 211,500 in March. So January 215,000 units. The production is in units. February 184,500 units. And in March, we have 211,500 units. Then you now multiply the budgeted production by the standard rate per unit. Standard rate. The standard rate per unit is 6 naira as given in the question. I've told you if you either multiply the budgeted production by the standard rate of 6 naira per unit to get the direct wages incurred in each of the months. Or if you don't want to do it that way, I've told you that you may also multiply the budgeted production by the standard hour per unit. And the standard hour per unit is half of an hour. Half of 215,000. 215,000 divided by 2. That gives us 107,500. The 107,500 represents the budgeted hour. The budgeted hour, you now multiply by the standard rate per hour given in the question. The standard rate per hour given in the question is 12 naira. Multiply by 12 naira. You can see that information at the beginning of the question. I've captured that earlier. Times 12 naira. So you have 1,290,000. That is half times this times 12. It will give you 1,290,000. Or just multiply 215,000 by 6 naira. 215,000 times 6. That gives us 1,290,000 naira. That is direct wages. 1,290,000. In the month of February, the direct wages amounted to 184,500 times 6 naira. That gives us 1,107,000. And in the month of March, you have 211,500 times 6 naira. That gives us 1,269,000. Remember in the note, you were told that direct wages are paid in the month they were incurred. Since those wages are paid in the month they were incurred, that means you will include them in the cash budget in the very month those wages were incurred. So we have working number 3. So working 3, we got 1,290,000 for the month of January. And the month of February, we have 1,107,000. And in March, we have 1,290,000. 269,000. So if you sum up the direct wages incurred or paid in those 3 months time or period, so we have $3,666,000. That is direct wages. You were told, in addition, variable overheads have been determined as 2 naira per unit. Remember, variable overheads are costs that change with the level of activity. So the change with production. As the production increases, variable overheads also increase. So it means it is the units produced that will be used to multiply the variable overheads in order to get the amount incurred for each of the months. So we multiply 2 naira by the units produced, that is, the unit produced from the production budget. Working number 4. Variable overheads. Three months are to be considered. We have March, February, and January. From our production budget, we have the budgeted production. The budgeted production is obtained from the production budget, 215,000, 184, 500, 211, 500. So which is still the same figures used here. Budgeted production, 215,000 in the month of January. In February, we have 184, 500. And in March, 211, 500. So we have the standard rate per unit. The variable overheads given in the question, 2 naira. 2 naira is the rate per unit. So variable overheads cost. In order to get the variable overheads cost, you multiply the units produced by the standard rate per unit of 2 naira. So we have 430,000. And in the month of February, 184, 500 times 2. We have 369,000. In March, we have 211, 500 times 2. That gives us 423,000. Variable overheads are paid 60% in the month in which they are incurred and 40% in the following month. So 60% will be paid the very month those variable overheads were incurred, and another 40% will be paid in the following month. So we want to apportion the variable overheads on the basis of their time lag. So we have 60% same month, 40% in the following month. $40% in the following month. So 60% of 430,000 will be paid in the month of January. No, the amount incurred in the month of January is 430,000. 60% of that is 258,000. Then of February, variable overhead cost of 369,000. 60% of that will be paid in the month of February, and that amounted to 221,400. And the amount incurred in the month of March is 423,000. 60% of 423,000 will be paid in the month of March, and that is 253,800. Then 40% of the amount incurred will be paid in the following month. 40% of the amount incurred in a month or in a particular month will be paid in the following month. That means 40% of 430,000 incurred in January will be paid in February. 40% of 369,000 incurred in February will be paid in March. So now, let's calculate 40% of 430,000. That gives us 172,000. That means of the 430,000 incurred as variable overheads in the month of January, 40% of it will be paid in the month of February. Therefore, how much were incurred in the month of February? How much will be paid in the month of February? 172,000 plus 221,400. The amount that will be paid as variable overheads in the month of February is total 393,400. Then 40% of the variable overheads incurred in the month of February will be paid in the month of March. So 40% of 369,000. That gives us 147,600. Then if you add 147,600 to 253,800, we have 401,400. Now, back to the footnote. So, at 1st of January 2023, creditors for variable and fixed overheads are estimated as 92,000. This is variable overheads and 150,000 respectively. This is variable overheads creditors. That means as at 1st of January 2023, it means the amount outstanding, the outstanding variable overheads, that is creditor for variable overheads, the one that have not been paid as at the end of 2022, which is December 2022, which was brought forward to January 1st, 2023. The variable overhead that have not been paid then amounted to 92,000. Remember, it were apportioned into two. 60% will be paid in the very month they were incurred, and 40% will be paid the following month. It shows that of the amount incurred in December 2022, 40% that were not paid in 2022 December, which will be paid in January 2023. That is this 92,000 they are referring to here. So we will include this 92,000 in the variable overheads to be paid in January 2023. In 2022 January, creditor for variable overheads of 92,000 will be considered. So if you add the 92,000 to the 258,000 we have in January, you have 258,000 plus 92,000, and that is totaled 350,000. The variable overheads that will be paid in the month of January 2023 amounted to 350,000. So We will include 350,000 in the cash budget in the month of January, 393,400 in February, and 404, 401, 400 will be included in the month of March 2023. So now back to the cash budget. We have variable overheads. Variable overheads, that is working number 4. In the month of January, we have 350,000 as obtained. In February, we have 393,400. In March, we have 401,400. So if you sum up the three amounts, 350,000 plus 393,400 plus 401,400. So the amount paid in the first quarter of the year 2023 amounted to 1,144,800. After variable overheads, we have fixed overheads. Remember, if you check the note, you were told depreciation of 25,000 naira were included in the fixed overheads. Fixed overheads include 25,000 naira of depreciation. Since depreciation is not a cash flows, you will need to subtract 25,000 naira from the fixed overheads and are paid 1 month after the costs are incurred. It means of the next difference, the one for December 2022 is the amount that will be paid in January 2023. I paid 1 month after the costs are incurred. The one for December 2022 will be paid in January 2023, and the amount of fees overheads incurred in January 2023 will be paid in February 2023, and the one incurred in February 2023 will be paid in March 2023, in that order. Now, let's consider. Remember, you were told our fees overheads are at 1st of January 2023. Creditors for variable overheads, variable and fees overheads are estimated as, this is variable overheads, we have used that, and that of fees overheads amounted to 150,000 naira respectively. This is the creditor, the outstanding one, the fees overheads that have not been paid. So this amount will be considered in January 2023. No, this is an outstanding balance as at December 2022, which was brought forward to January 2023. So this will be the amount that will be paid in January 2023. The amount incurred in January 2023 will now be paid in February, and in that order. Less depreciation of 25,000. 25,000 naira. The amount outstanding in January amounted to 150,000. That one is exclusive of depreciation. And that is the amount that will be paid in January 2023. So how much is the fees overheads cost incurred in January 2023? Remember, the amount incurred in January 2023 will be paid in February, and the one incurred in February will be paid in March. So in that order. In addition, variable overheads have been determined as 2 naira per unit. Variable overheads have been considered. And monthly fees overheads are 200,000 naira. So this is the fees overheads incurred on a monthly basis. Remember, the amount incurred in January will be considered in February. Remember, you were told in the note that it includes depreciation of 25,000. That means we will need to subtract 25,000 from 200,000. That means you'll be getting 175,000. The amount that will be payable on a monthly basis becomes 175,000. Since depreciation is not a cash flows, depreciation is not a cash flows. That is why depreciation is to be subtracted. 200,000 minus 25,000, that gives us 175,000. Remember, fixed overheads is 200K minus depreciation of 25K. So that gives us 175K. And the 150,000 here is the amount the creditors for fees overheads for previous year, which will be paid in the 1st of January of the following year. So for March now, since it is still 200,000, so you'll be having 175,000. So how much is the total fees overheads cost incurred in the first quarter of the year 2023? I mean, the amount paid. 150,000 plus 175,000 plus 175,000. That gives us 500,000 naira. 500,000 naira. Now, let's go through the additional information. In order to ascertain it, there are further information or items that need to be incorporated or included in our cash budget. So we have used this 150,000 fees overheads. The company intends to have finished stocks. These are information about the inventories. The inventories were used in the production budget and material usage budget. So the inventories. So the rest of the notes are all about inventories. So this note is also on inventory, the closing inventory. So except this cash balance. This is total payments. Let's have our total payments as B. So we have 1,463,875 plus 1,290,000 plus 350,000 plus 150,000. And this is totaled 3,253,875. Now, if this is the total receipts, let's have our receipts to be A. So receipts minus payment, that will give us net cash flows. Receipts less payments, A minus B. 3,253,875 subtracted from 3.6 million. We have the net difference of 346,125. 346,125. For the month of February, 1,338,750 plus 1,107,000 plus 393,400 plus 175,000. The payment items are total 3,014,150. If you subtract payment from the receipts of 3,285,000, so we have the net cash flows of 270,850. In the month of March, the payment is totaled 1,490,000 plus 1,269,000 plus 401,400 plus 175,000. So the payments items are totaled 3,335,525. So if you subtract it from the receipts, 3,456,000. We have 120,475. Then the total column, we have 4,292,750 750 plus 3,666,000 plus 1,144,800 plus 500,000. This is totaled 9,603,550. If you subtract it from the total receipts of 10,341,000, you have the net cash flows of 737,450. Now, in the footnote, you were told the cash balance at 1st of January 2023 is estimated as 31,000 naira. So we have 31,000 naira as the opening cash balance. So this opening cash balance will be included in our cash budget. So we have opening cash balance, and we have that to be 31,000. So if you now add the opening balance to the net cash flows, you arrive at the closing cash balance. So we have 346,125 plus 31,000, and that is totaled 377,125. The closing balance in the month of January becomes the opening balance in February. So in February, we have the opening balance to be 377,125. What we have as the closing balance in January becomes the opening balance in February, plus the net cash flows of 270,850. So we have 647,975. So what we have as the closing balance in February becomes the opening balance in March, 647,975. So if you add it to 120,475, we have the net cash flows to be 768,450. So the opening balance you have here is what you will still put in the total column, which is 31,000. If you add 31,000 to 737,450, that is totaled 768,450. The total must not exceed what you have as the closing balance. They must be the same. This is the solution to the cash budget. In the requirement D, you have to prepare the budgeted profit and loss account for the 3 months period. Budgeted profit and loss account for the 3 months, the 3 months ended March 31st, 2023. Remember, your profit or loss, the starting point is always the revenue. Revenue should be the starting point. Revenue. Remember, your profit or loss is prepared in line with accrual basis, not cash basis. It means you are not going to include the items of receipts or payments in the cash in the budgeted profit or loss. You include an items into the budgeted profit or loss when the revenue are earned or when expenditure are incurred. Capital expenditure should be excluded. Budgeted profit or loss, you include the items of revenue and expenditure when they are earned or incurred. When they are earned or incurred, not when cash is or are received or paid. You are using accrual basis in preparing your budgeted profit or loss. Now, if you go back to our note, you were given the sales made for the 3 months period. Budgeted sales in units is 210,000, 180,000, and 210,000. You want to calculate the budgeted revenue. So you can add the budgeted sales in units multiplied by the selling price. So we have 210,000 units for the month of January, February 180,000 units. In March, we have 210,000 units. So this unit you multiply by the standard selling price. That will give you the budgeted revenue. The units sold in January is 210,000, February 180,000, March 210,000 units. These are the 3 units sales in units I added. You were told the selling price is 18 naira per unit. So you multiply the budgeted sales unit by the selling price. That will give you the budgeted sales revenue for the period. So we have 18 naira as the selling price. So we have 210,000 units plus 180,000 plus 210,000 units. The sales unit is 600,000 times selling price of 18 naira. We have 10.8 million naira. 10,800,000 naira. That is sales unit less variable costs, or let's say less direct cost or variable costs. If you want to get contribution, you less variable cost. So the starting point is opening inventory. Opening inventories. Remember, we have 2 types of inventories in this question. We have inventories of raw materials and inventories of finished goods. These are the inventories we have in the question. And how much is the opening inventories of raw materials? It was given in the additional information, and the same units have been used in the material purchase budget. It was given in the additional information, and we have opening inventories of raw materials 104,000, which was used in material purchase budget. Now, how much is the standard price per unit of material? Purchase price 3 naira 50 kobo. So if you want to value it now, 104,000 times 3 naira 50 kobo. This was given in the question as well. So 104,000 times 3.5, that will give you the opening inventories. So let's value it now. We have opening inventories of raw material 104,000 kg times 3.5. That gives us, we have 364,000. That gives us 364,000 naira. Inventories of finished goods. And these were used in the production budget. In our from our production budget, we have the opening inventories, 22,000 units. This 22,000 units was given in the question as well. 22,000 units. We have 22,000 times standard cost. Multiply this by standard cost. Now let's go back to the question. We were told a standard cost has been estimated on the basis of direct cost of 7 naira for materials. Let's have our standard cost. Standard cost. We have materials, 7 naira. This 7 naira was obtained by multiplying 2 kg at 3 naira 50 kobo per kg. That gave you 7 naira for materials. And 6 naira for wages. We have wages, 6 naira. The 6 naira was obtained by multiplying half an hour by 12 naira. Half hour at 12 naira per hour. That gives you 6 naira. In addition, variable overheads have been determined as 2 naira per unit. So we have variable overheads. That is 2 naira. If you sum up this now, because the next item is fixed overheads, so the standard cost now will be this plus this 8 plus 7, 15. So this is a standard marginal cost. I've told you if it is a standard absorption costing, then the fixed overheads will have been absorbed. Since you have been told the standard you are given, they are based on direct cost. So it means it is standard marginal costing you are expected to use. So, and where the examiner expects you to use standard absorption costing, fixed cost, they will give you the cost per unit of fixed cost, or they will tell you to use standard absorption costing. So the standard cost now is 15 naira. We will use this 15 naira to value our inventory of finished goods. So we multiply the finished goods in unit by the standard absorption costing and standard marginal costing of 15 naira, which have been calculated. This 22,000 units is given in the question as the opening inventory of finished goods. 22,000 times 15, that gives us 330,000. 330,000. After the opening inventories, the next thing is purchase. Purchases. We have purchases, which is material purchase. You are given purchase for materials in the question. So now let's go to our budget. Material purchase budget. So how much are the value of the materials? So in the month of January, from our material purchase budget, January 1,463,875. In February, 1,338,750. In March, 1,490,125. We will sum up the budgeted purchase for the 3 months period and include them in our budgeted profit or loss. So in the month of March, we have 1,463,875. In February, 1,338,750. In March, 490, 125. So the sum of these will be the budgeted material purchase in the period 1,463,875 plus 1,338,750 plus 1,490,125, and that gives us 4,292,750. Then we will need to consider other variable costs aside the material. Then we have direct wages, which was obtained from labor cost budget. So we have direct wages of 1,290,000 in the month of January. Direct wages 1,290,000 in January, 1,107,000 in February, and 1,269,000 in March. So we have direct wages in January, 1,290,000. In February, 1,107,000. In March, 1,269,000. So we sum them up. 1,290,000 plus 1,107,000 plus 1,269,000. So that is totaled 3,666,000. Aside direct wages, we equally have variable overheads. Variable overheads. It is the amount incurred you need and not the amount paid. So now let's go through the note. Working number 4. We got direct wages from working 3. Variable overheads. The amount incurred as variable overheads. Variable overhead cost is this: 430,000, 369,000, and 423,000. These are the amount paid. What you need is the amount incurred and not the amount paid. So it means you include expenditure when they are incurred and not when paid. So the amount incurred, we will consider 430,000, 369,000, and 423,000. So that is from working number 4. So that is for variable overheads. No, the direct wages is working 3. Variable overheads working number 4. In the month of January, we have 430,000. In February, we have 369,000. In March, we have 423,000. So we sum up the variable overhead costs incurred. So we have 430,000 plus 369,000 plus 423,000. So the total is 1,222,000. So now let's sum up this. Plus 3,666,000 plus 4,292,750 plus 330,000 plus 364,000. So the total is 9,874,750. So We now less our closing inventories. Less closing inventories, which is equally divided into two. The closing inventories of raw materials and the closing inventories of finished goods. Raw materials and that of finished goods. So the closing inventories of raw materials, let's go back to the material purchase budget. Our closing inventories of raw materials have been calculated in material purchase budget. We have the closing inventories. Closing inventories. Raw materials. So the closing, the last period, what you have as a closing inventory in the month of March will be used. Since the budgeted period, the last period, the last month, the final month in the budgeted period is March. So 108,500 will be used. So as closing inventories of raw materials. Now, let's include that in our budget, in our budgeted profit or loss. 108,500. This will be valued at the standard material price, and which is 3 naira 50 kobo. It is this 3 naira 50 kobo is given in the question. It is given 3 naira 50 kobo. 108,500 times 3.5. You have 379,750. We normally subtract the closing inventories. That of finished goods. The closing inventories of finished goods will be obtained from the production budget. And in our production budget, we have closing inventories. These are closing inventories. The last month, which is March, we have that to be 33,000. So our closing inventories of finished goods is 33,000. So, and we will value that at our standard cost, 33,000. This 33,000 is obtained from the production budget, while the 108,500 is obtained from the material purchase budget, times the same standard price we use to value the opening inventory, which is 15 naira. That same standard price will be used in valuing the closing inventories, the 15 naira times 15 naira. So we have 33,000 times 15. That gives us 495,000. 495,000. So now let's deduct the closing inventories from 9 million. So 9 million is 74. 9 million is 74,750 minus 379,750 minus 495,000. So we have 9 million. So we have 9 million. The 9 million is our budgeted contribution. We have the budgeted contribution of 9 million naira. Sorry, the variable cost is 9 million. So our budgeted contribution now deduct the cost of sales or variable cost, deduct it from revenue of 10.8 million. So we have budgeted contribution of 1.8 million. That is budgeted contribution, 1.8 million. Less fixed costs. Fixed costs. Our fixed cost we were told is 200,000 per month. So since you have January, February, March, 3 months, so that means the depreciation and the fixed cost to consider will amount to 600,000. Remember, depreciation is part of this. Depreciation of 25,000 is part of our fixed cost. So depreciation will be used in the budgeted profit or loss. That is why we are not subtracting depreciation here. Then we also have bad debts. Bad debts. You were told your bad debts, and you were told in the note, it is expected that 5% will be irrecoverable and will be written off in the month of sales as bad debts. So bad debts, 5%. You calculate 5% of your revenue. Our revenue is 10.8 million. 5% of 10.8 million will be the bad debts that will be charged. 10.8 million. That gives us 540,000. So if you sum up 540,000 and 600,000, so we have 1,140,000. If you subtract 1,140,000 from 1.8 million, then you have 660,000. The 660,000 is our net profit. So this marks the end of the solution to this question. Be expecting the part 2 of master budget that will contain more detailed questions from workout performance management by Omoleyiwa. This question 2 is equally obtained from workout performance management. So please make sure you drop the love emoji, like the video, and also share it with others. Thanks for watching ZICA.